Hey, what's up, everyone? Welcome back to my world of stocks and welcome back to my three stocks on sale series for the month of April 2025, where I give you three new stocks every month that I feel are on sale right now at today's prices for the long term. And guess what? You're not going to want to miss this month's episode because I'm including two stocks that I've rarely ever talked about. And stock number two, I don't think I've ever mentioned before, but I'm actually behind some of it for the first time ever now. So I can't wait to share it with you. Now, normally I do try to give you guys one lower risk, one medium risk, and one higher risk option just for some added variety. But this month will be a little different. It's actually going to be two medium risk and one high risk. So a little riskier than usual, but I really like all of these, and here's why. Let's go ahead and jump straight into it. Now, stock number one, I'm starting with the first of the two medium risk options, and I really want to talk to you this month about Expedia Group, ticker symbol EXPE, which I do not currently own myself, but it is probably the highest up on my watch list right now that I am heavily considering adding. And here's why. Now, first of all, after the pandemic, seeing how easily travel stocks can be destroyed by the government shutting everything down, I kind of swore off travel stocks for that reason, other than Disney, because I do feel that they're more diversified apart from that. But I got to say, following a strong recovery now in the travels market, which I'll get into in a second here, coupled with how much I love Expedia's business with still a very cheap valuation, it's actually got me very interested in the stock again. And here's why. Now, you look at the business, Expedia owns so many strong brands in travel and online booking. In fact, when you look at just the US lodging market alone, you would think Airbnb would completely dominate that. But in fact, Airbnb only holds around 17% market share, whereas Expedia, alongside their various apps like Vrbo and Hotels.com, actually leads with close to 40% share. Now, meanwhile, Booking Holdings comes in second place at just a bit over 20%, alongside their Priceline and Kayak platforms too. Now, to be clear, internationally, it's a completely different story where Booking is much larger and more popular, especially in Europe, where they completely dominate that market. But my point is that Expedia is actually larger than I would say most people realize. Even most investors who usually own Airbnb for the higher growth or Booking for the larger size. But I've always felt like Expedia kind of fits in as that great alternative, kind of in the middle there, with a much cheaper valuation than the other two. Now, you look at the stocks, for example, Booking has almost always been a strong performer and is up close to 300% just since the pandemic alone, whereas Expedia is only up less than 80% over the past 10 years in what looks like some pretty heavy suppression to me there. I mean, only being up that much it's not a whole lot, right, for an entire decade of time. However, the good thing is that worse performance at least leaves them with a PEG ratio of not only less than one, but it's also 44% cheaper than the sector, despite them being a market leader in their own right. So I just think that's a great value there. Booking and Airbnb, on the other hand, they actually trade for PEGs that are more than double that of Expedia's. Again, there's obviously certain things to like about each of these, but as a whole, I just think Expedia looks the most attractive at the moment, especially with the travel market having fully recovered now from the pandemic, with both flights and even cruises being back up to record highs, resulting in Expedia posting double-digit growth in room nights, gross bookings, revenue growth, and across all three of their core consumer brands, Expedia, Hotels.com, and Vrbo, in their last reported quarter. They also reinstated their dividend, which was cut during the pandemic. Their total sales are now growing by at least a mid-single digit percent, with EPS growing by double digits too. And the company is just overall, in my opinion, looking like they're in a very strong position right now with market leading brands, yet the stock price continues to trade what I feel is dirt cheap on virtually all metrics, at least when compared to their peers. So other than just being a travel related stock that can be, hurt by macro conditions, I kind of feel like there's a lot going on here for the stock. And it's why I'm even thinking about buying some shares myself too, even though, again, I'm a little traumatized from the pandemic where travel stocks got destroyed. I owned Delta and Carnival. Those stocks took a beating during that time. But just for now, looking after the recovery, I'm excited about Expedia once more, and I'm considering it. Okay, while I haven't picked up Expedia stock quite yet, stock number two, I actually did decide to start buying today for the first time ever. And it's also a stock that I don't think I've ever even talked about before on the channel. So I can't wait to share it with you. And that's going to be our other medium risk option in the heavily beaten down Dividend King, known as Stanley Black& Decker, ticker symbol SWK. Now, most of you, or at least anyone who uses tools, maybe does a little manual labor out there, you've probably heard of this company or any number of their extremely popular brands, not just Stanley and Black& Decker, but also DeWalt, Craftsman, Stanley, Irwin, and more. In fact, I could even go into my tool storage right now and pull out most of those brands myself. I own quite a few of those, which I don't think I'm alone in, by the way. In fact, Stanley, they claim to not only have number one market share, Stanley Black & Decker as an entire company with all their brands, they claim number one market share for tools and outdoor products in the entire world. And they also operate in 60 different countries, with even 90% of all cars and light trucks in Europe and North America using their specific fasteners. So that's pretty big. And yet the stock price has actually been devastated from the top, losing over 75% of its entire value, to where it now trades for even less today than it did an entire decade ago. And the reason why is actually very simple. See, like many other stocks that crashed, after the pandemic, Stanley was actually doing very well during the pandemic, when all that stimulus money got pumped into the economy and into people's pockets, making it easier to buy tools and work on various renovation projects, thus sending their revenues and profits soaring to new record highs, growing by 20% and 36% respectively in 2021, for example. However, once that stimulus money started drying up and we were really left with crippling inflation and high interest rates, well, so too did their financials start crashing back down, with EPS falling by 33% the following year, turning negative the year after that, with also declining sales in both 2023 and 2024. However, they're now finally expected to start rebounding in the coming years, with stabilizing sales and soaring EPS, which, by the way, analysts think will start approaching those previous record highs once more on both the top and bottom line. In other words, the pandemic caused both a boom and a bust, like it did for many companies, many stocks out there, which is where we're at now, trying to rebound from the past couple years. The good news, though, is that investors haven't really returned to the stock yet, which has left this market leader actually trading 20% cheaper than the sector on a PE ratio basis, and close to 50% cheaper on a PEG basis too. But here's the best part, guys, the mouth-watering dividend that they've now grown for over 5 decades in a row, with a yield that has also risen to well over 4%, which is among the highest levels it's ever been. Again, though, all of this value is only attractive here if Stanley can actually execute a rebound and get back on track, which most analysts, to be fair, think they will, with even the lowest price targets sitting well above where they currently trade today. But with tariffs, a new presidency, lingering inflation, interest rates, some volatility, still a lot of uncertainty out there in the macroeconomy that could derail those plans. So it's why I do consider them to be a bit risky. But at these levels, I just think it's worth the bet long term. So I'm starting to buy some of the stock myself. All right, guys, that'll leave us now with the third and final stock of the list, the highest risk option of the bunch. And look, for this one, if my parameters are a high risk, speculative stock that I think could have a very bright future, well, there's really no other stock that I think fits those parameters better than C3.ai, an unprofitable, speculative stock, but with potential. And here's why. First of all, I'll get into why it's high risk in just a second, but in terms of future potential, and considering the current environment of a shaky economy, inflation, interest rates, and even tariffs, I actually think an AI software specialist that has almost zero direct exposure to tariffs, who also uses that software to help and improve the efficiency of other companies, again, in a weak economy where it's, super important to save on costs, volatile uncertainty out there, well, C3 is like the perfect fit for that, because it's exactly what they do. And because of it, they're seeing rising demand now, even during this challenging environment, even managing to partner with some of the biggest, most dominant tech giants out there like Microsoft, Google, Amazon, and more to sell these AI services to other companies, where they saw a 74% year over year increase in customers through that partner network, and even a 460% quarter over quarter improvement through their newest Microsoft partnership alone too. In other words, companies are still trying to cut costs, but they're choosing to hire C3 regardless because they actually help them with that, with those missions, with those goals. And they help them grow and utilize AI so that they can stay competitive in a very crowded market. Like at this point, no one can really afford to cut back on AI investments. If you do that, you risk falling behind the competition at this point. And that's why you're seeing so much success for providers like C3, or especially in the case of Palantir. Unlike Palantir, though, C3 is much smaller and not profitable. And while they are growing sales, by over 20% now, with EPS, it's expected to either double, maybe even triple at times. Well, the fact is that they are still nowhere near the same level of Palantir. And because of that, the market has actually punished C3 a lot more, since really any time that the market is going down, companies that are not profitable, those stocks are always going to get hit the worst. And that's what we saw with C3, because investors are really flocking over to safer options with more stability, that they trust more, that are actually profitable. And so we saw that with the stock. It's now crashed by close to 40% just this year alone. And let's face it, it's been obliterated really since IPOing. While Palantir, on the other hand, well, it's actually positive this year, and it's up over 800% during a similar time period. But Palantir is also 73 times larger by market cap, and it trades for a price to sales ratio that is 11 times higher too. To be clear though, I like Palantir stock way more. I trust it a lot more, and I own a much larger amount of that stock, whereas I only have a small amount of C3 in my portfolio. But as specifically a speculative, higher risk option, again, C3 is probably my favorite in the market right now for that specific purpose alone. Anyway, that's going to do it for this video. I hope that you enjoyed it. Let me know what you think down below about the stocks I brought up to you today, and let me know what other stocks you're all buying out there. Maybe I'll include them in a future video. But thanks again for all of your support, my friends. Thank you for stopping by. I hope you're all doing well, and I will catch you in the next one. All right, take care, everybody. Bye-bye.